All right, so we're talking about liquidity engineering and flow analysis. So what happened, before you can talk about liquidity engineering, you want to know about the market cycle. And then this is what an ideal day is all about. The market consolidates in the Asian, induce or initiate, mark down, and then close around this point, and then come back into the end of the consolidation. So this is what we always have. In such a case that the market maker initially created a high of the day, and then creates initial low of the day, then trap. This is an ideal day, and then trap, and then end of day. End of day, trap. Let me put this one to be open day, trap, and then end of day consolidation. EOD, consolidation. All right, consolidation. I don't know what class or what school of thought you've come from, but technically, I want to say the market maker, your job as a trader is to look for your primary assignments. Your primary assignments is to look for where people are keeping their stop loss. Okay, is to look for people SL and take it. So reason like the banks. All right. So these are the very basis. One, the market often will reverse to the mean of the day to create the initial force move day / week / or let me say force move session beginning. Now, also, it is upon these premises that liquidity engineering is founded. Engineering is founded, okay? Now, what are liquidity engineering and what are the liquidity zones on the chart? We're talking about the previous day high, the previous day low, the initial high of the day, initial low of the day, and then we equally talking about the previous week high, the previous week low, and then also we might not talk about the month because most of us are intraday based, and then we're talking about the trend EMA, which is the 200 EMA on the chart. Okay, so those are the liquidities that we have in the market. So two things are possible in the market during the London session, Asia session. The Asia session is called the cost phase. The cost is called the cost phase of the market. Okay, so then the London into the New York is often considered to be the result phase. Okay, so, or let me say the effect phase of the market. Okay, result of the effect phase of the market. These are the kind of move that create this first move. I'll say first move session beginning, FMSB is always the reason why people lose money in the market. So now two things are possible. The market at the beginning of the London, we often want to cause what we call initiation or inducement. let's pay attention to this. This is where our London, our type 1, type 2, or type 3 London pattern originates from. So now let's say this is the high of yesterday. Tendency is that the Asian can consolidate just below. Tendency that let's say this is the high of the day, tendency is that the Asian could have formed a new high above it. Let's say, so these are the things that are possible. Now let's say this is the low of the day. Tendency is that Asia could consolidate above it. Let's say this is the low of the day. Asia could have formed a new low below it. Now, so these are the possible likely situations that can happen in a bearish market. Asia consolidates just below the previous day high. So in this case, I will say this is my previous day high. Then I will say in this case, this is also my previous day high. Now, in a case where the Asian consolidates above the previous day high, that means creating a new high at the beginning of the day, we pay attention to the initial high of the day as our liquidity pool. In a case where the market consolidates below the previous day high, we pay attention to the previous day high as liquidity pool. Now, in a case where the market consolidates above the previous day low, we use this as our liquidity pool. And in a case where the market consolidates previous day low, just above it, we use the initial low of the day as liquidity pool. Now, let's get it clearer now. So invariably, I will take a snapshot of this and I'll post it to the group. I hope somebody will just want to pay reference to this later on. So I'm going to take a snapshot of this and I'm going to put it in the group here. Save. So let's put it that way, and then I'll keep this. Let me put it somewhere. So let me put it somewhere there. Then I'll come back to this. I'll clear this board and I'll start my presentation. So let's say the market consolidates in the Asian just below the previous day high. So now we have the barrier in this market to be the previous day high. Since two things are possible. In the London, in a case where the Asian is unable to create a new high below the previous day low. Now, this is what happens most time. Failure to create a new high is a sign that the market is possibly unlikely to make it even in the London session. So what you want to do as a trader in the London session is to look left. Looking left means that you want to see the face of the market where you are. Let's say the market has been doing like this. Let's say the market has been doing like this and now start consolidating. So possibility is that you want to see something like this. Now, we call it a liquidity grab. That means the trap above this previous day high. Because normally some people had a buy order, or let me say people that sold this market on the previous day, like seriously like this. Let me draw it well this time around. Now, let's say this is the previous day high. This is the high of yesterday. Let me put it this way. Let's say this is the previous day high. Yeah. So now the market now consolidates like this in the Asian and move this way. All right. So this is what we now had in the Asian. And then note that the market is now consolidating in the Asian sideways. So since the previous day high is still very much intact, the previous day high is considered to be a liquidity pool because people that sold this market yesterday's high act their stop loss around this point. And some retail traders often believe that since the market is bullish, of course, you can see that the market is bullish. You can see that maybe 200 EMA is going up, and then the trend line trader will be looking at a bullish market phase. They want to place a buy stop with a view that the market will continue to go up forever. Now, in the London, the market consolidated all through the Asian, thereby creating a liquidity just around this point, and also knowing that there is a stop loss around this point and buy stop order in the market. What the market does is come up, create a drop. Now, when it creates this drop, it traps just a little bit below this level. In this case, this is the Asian midline. Now, in the Asian midline, let's say this is 50 EMA. Now, what the market has done successfully here is to create a liquidity grab around this point, and therefore constituting what we call a radiant effect. And this radiant effect will now open a drop below the 50 EMA on the intraday, and possibly even take the low of the Asian low away. In this case, we now have a pullback back to the 50 EMA and also to the Asian midline, and then we'll have a refreshment to the downside. This is the anatomy of the AR50 that we often talk about. Now, this is point number one, a case study of AR50 that we often talk about. So let's take a look at this chart and possibly take a safe entry of this and keep it in the group. Now, I'm going to save this also in the section here. Then I'll go to the, okay, let me just hold on. All right, so now let's take a look at the next action. In the case where the market made a new high, let's say the market was going up like this, and this happens to be yesterday's high. Okay, so the Asian now consolidate obviously and create a new high. No, let me do it well. Let's say this is the previous day high. So the Asian upon at the point make consolidate, and maybe before the London opened, we now had a new high like this. Now, in the case where the new high, the Asian has been the new high has been created, so we are going to be respecting the previous day, the initial high of the day, as a key level in this case. Now, before the violation of the previous, let's say this is going to be the Asian low or whichever, and let's say this is the Asian high. Obviously, this possibly may be around the midline of the Asian, and let's say 50 EMA is going to be something like this. Now, what you do in this case is that you want to trade the London. Now, the market will often do a look back into the face here and consider the violation here. People that did a buy are above this level. So people will equally see that they will now have a new high, they start buying. And then what the market will do in the Frankfurt into the London session is to make a pullback, sluggish pullback into maybe the 50 EMA in this case, or the initial high of the day that was violated, previous day high, and therefore start a run up in the London session. Now, in this case, we're going to be looking at the fact that the market has created a new high, thereby making the previous day high to be significantly relevant. I mean, irrelevant again. We now open a market pullback to the breaker block, or let me say the consolidation that was created prior to the violation of the high. And this pullback is often considered to be very vital. This is the basis for which we have our AR00. So this is the basis for which we have our AR50 or AR00, depending on where the 50 EMA is. So when it comes to directional bias and means, directional bias is often identified by you looking at the market position versus 50 EMA versus current market price at London Open. London Open. Now, somebody will ask you, how do you determine your directional bias? EMA versus the current market price at London Open equals to the directional bias. Equals to directional bias. Okay. Now, sometimes the mean of the day is often equals to the previous day high, the previous day low, the previous day close, and divided by 3, which equals to the daily pivots. In case you don't know this, this is the mean of the day. So in the London session, when you open your chart and you identify the pivot, which is the pivot line that you always have in your chart, and then you identify your 50 EMA and you see that the market is trading below it, your job is to look for a sell, and maybe this is the high of the day, and then hunt it down. In this case, where you expect a breakout, let's say the previous day low is around this point, right? Let's say this is the previous day low at this point. So as at the time the market finished the Asian, initial high of the day is now the nearest liquidity pool in that point. Like I said, always have it at the back of your mind that the previous day low, the previous day high, initial high of the day, initial low of the day, and then the thermal, that is 20 EMA, 200 EMA, 200 EMA, and also the previous, let's say you are looking at the intraday only. Those are the key factors you want to pay attention to. And also, so when you look at the market, it's below the pivot plus, and let's say and 50 EMA, then look for sell in that market. Now, when you're selling this market, if let's say you have initial high of the day just around this point, below this, so you are looking at a market breaking out of this initial high of the day, trapping the liquidity pool just above this initial high of the day. But because you knew that this breakout would be a failure, as it is currently trading below the intraday pivot, you wouldn't buy, you wouldn't be a victim of this breakout. Then you knew that the market maker is possibly likely. So immediately you see a candlestick formation that warrants a market jumping, going down, then you want to start selling in line with the directional bias. Now, at what point is your directional bias going to be switched? Now, if markets make a violation that similarly violates the 50 EMA and the initial pivot of the day. Now, this initial high of the day, which is the Asian high, is often the basis for our relationship in this market. Now, immediately the market violates the 50 EMA, of course, there will be what we call a pullback back to the initial high of the day. Then this is the new trend. This is the basis for our AR00 in forex market that we often talk about in Btmm. Now, that is the anatomy of AR00. In this case, the market has violated the 50 EMA, violated the daily pivot, and now it has changed the bias from bearish to bullish, and therefore a retest of the previous high or initial high of the day that was violated is now going to become resistant, violated becoming support, which is a retail concept. Sometimes you want to apply trend line and then you will have something like this, and that settles a whole lot of things. You do not need too much of analysis on your chart to get this clear. Now, you just have to be thinking like banks here. You know that when the market creates a consolidation in the Asian and create a high of the day, now for a sell, you want to induce against the initial high of the day or the pivot setup of in the market. So let's take a look at some charts example. So I'm going to be using, you can, if you have a chart example, just give me an example of what you want. Boss, I noticed you are using 50 EMA and not 55 EMA. No, it's still the same thing, but I'm talking about conceptual Btmm approach here for some other members that are in this group. So everything is still the same. So now let's take a look at the market from the Euro AUD point of view. I'll just look at this. Now I'm going to look at Euro AUD. I want to be looking at the possibility of selling this market. Why? Because as at the time the market opens at this point, the market is still trading above this level. Now, this is the initial pivot of the day, which I want to sell below. So market has created a low here, right? Now, the market is still possible. Market made a anchor zone like this to the upside. So I'm going to create this possibility. So market has created a violation at this point. So I'm going to be looking at that as a break block, and therefore I want to see that I'm not going to sell this market while it is trading above the daily value. So a sell is only going to be warranted if I can see a close back below this level for a sell. So I will be waiting to sell this market around this point for a downside move. Now, more than often, you equally must have your high on the higher time frame market price action. Now, if you take a look at the weekly perspective, in this case, this is my weekly chart. I can see that last week ended with an engulfing. So I'm going to be looking at a possible rally and then drop this week in continuation of the last week engulfing structure. Now, this is the 240, this is the trend MA, which I have on this chart, which is currently acting as dynamic support and resistance. So a close below this level will open my sell possibility to the downside, considering the fact that yesterday equally on the daily time frame ended as an engulfing structure. Okay, so what are the liquidity engineering that is happening on this chart? Let's map out the liquidity engineering here. Now, just as we say, we're going to have to look at the low of the Asian into the high of the Asian, and then this is the initial high of the day. Now, the initial high of the day is established here. So I'll just put the initial high of the day, which is what is the Asian high. Now, I will say there is a breakout to the upside. This breakout wasn't meant to be successful because it is against the directional bias in this market. Now in this case, I'm going to be placing a sell stop just to confirm that in case the market comes down below this level, it will keep going down. I'll place a sell stop here, and then I'll place my stop loss here. Then I will multiply this zone by 2, and that will become my TP to the downside. Okay, I want to see a minimum of 2 times what I'm risking as my potential reward. In this case, I should be expecting a liquidity range of this zone as TP in this case. However, we all can play around this in our own little way. Now that the market looks violating, raiding the initial high of the day, which is a liquidity point, there is a liquidity at this point. So market breakout. This breakout here is called an inducement, and then with a follow up of a reversal. In this case, I'm sure you can see this. So if anything like go by this, a close below the 55 EMA or whatever here, we initiate my sell and possibly off that whatever. But nevertheless, if I place a sell stop at this point, I could consider this trade to be safe as possible. Okay. Now let's take a look at another pair. Let's say GJ. Now on GJ perspective, immediately the market opened in the northern session, we can see that the market was trading below the 50 the water and then the high of the day and then the pivots. Okay, so market just did a violation of the Asian low like this, quickly the market made a retracement and then started going down. Okay, with this being seen, we will possibly see now the market has violated the previous day low at this point. Okay, so if anything is to go by, the previous day low has been violated, there could be a retest of this low and then a continuation to the downside. Why do you want to be comfortable selling the market if it rejects the previous day low? Is because you can see that the directional bias is bearish. The market is currently in a bearish phase. The previous day low has been violated. The initial low of the day has been violated. So you can always respect resistance in a bearish bias market where the market is trading under the bearish pressure. So this is the support, which is now going to become resistant, and therefore a possible sell is recommended around the price 86 zone in this market. So let's take a look at CAD GU. So the GU equally has something similar to that effect. The previous low of the day has been violated here, and if that is anything to go by, you want to possibly say that the market is trading below its initial, below the trend MA and the daily pivot. So you want to look at resistance as a key zone. So hopefully the market does this, comes like this, and then you look for a sell pattern towards the downside. You want to respect resistance or whatever at under the bearish phase. So 55 EMA will come in this case and hit and form a confluence at that zone. And that settles that. First and foremost is you understanding the phase of the market. Is it in a bullish phase or bearish phase? This has to do with where the market is currently with respect to the 55 or 50 EMA and also the intraday pivot, which we call the mean of the day. Like we look at it, as at the time the market opened, the market came up and then fell and then start coming down like this. So we might see the third push of this market like this in a short while. Okay, you want to look at UCAD. So UCAD had a violation of the previous day high, and therefore we could possibly see that the market made a fake move like this, 50 EMA like this, and then we could see something like this. The high of the Asian around this point, the low of the Asia around this point, because the high and the low of the high of the market has violated the previous day high. So the high of Asian is now irrelevant. Rather, we will look at the consolidative phase in the Asian and then retest back to the 50 EMA as our continuation pattern in this case. So we are going to be looking at a possible drop to this zone on the UCAD and buy it back later in the whatever. We just trade it in line with the intraday bias and perspective in this case, and that settles it. Okay, so now invariably, let's take a look at some other thing in when we come to liquidity engineering. AU. Now AU has something similar. Bias is bearish because the market is below both the mean value and also the trend MA and everything. But nonetheless, the last liquidity that was taken out was the previous day low, which is already here. And before the violation of that previous day low, something happened. That's what we call initial base in the Asian. So this zone is very principal, and then we can possibly see a rally and a drop in this market with respect to understanding the current flow that is in the market. If you place your trend line, this is what you're going to have, and that corroborates our perspective in this market. And that's it to say. Taking a look at what happened last week, we could see that the market rejected this high and formed a pin bar rejection of this supply zone on the weekly time frame, and therefore this week might possibly be a continuation to the downside. So we should be very open-minded towards that and expecting it to happen. However, it is not impossible that the market can form a reversal and then go up. What confirms a reversal and go up? Let's say the market now recovers and go above this level, then it means that it has already reversed, because in this case the market will be trading above the 50 and 55 EMA accordingly, and then you can say the market has successfully reversed in this case to the upside. But not until this last high that was created, which is called the breaker block, is intact, market is expected to continue a bearish phase in this regards to the downside. I hope this corroborates and validates a whole lot of structural formation in the market. Now let's take a look at BTC. Okay, I don't want to use BTC because I don't have a wicked candles. So let's take a look at the user. User successfully made a high. This is the high of yesterday, right? So what happened? Liquidity around the zone, the market trapped it, and therefore you could see a possible drop in this used market with a view of coming down to this level. And if this level is violated like this, I could see a possible dip in this case with a view of coming low towards this demand zone, or a possible range of this previous day low. Always estimate or expect that the previous day low or the previous day high, the initial high of the day or the initial low of the day, or the trend MA, which is the 240 or the 200 EMA on your chart, will contain a liquidity pool that the market will often rate at any particular time when you're looking at it. So now, because this market has a tendency to snap up, so I'm going to be very wary. We have the intraday pivot around this point, which is the main. So with the fact that the market is trading above this level, if this market comes to this level, and there could be a bounce, but if it efficiently break this level, that means the mean of the day and the 55 EMA have been violated, and therefore what this means is that market bias and as switch, then we can sell to the downside. Okay, so when you look at this, let's take a look at gold market. Okay, I want to look at gold market. So now gold market has its bullish, is currently in the bullish phase, but the mean of the day is around this point. 55 EMA is around this point. So we could see a market drop in this case, and then we could see a rally from there. Like we say, market will always pull back to the mean of the day as at the open, whatever. It should be very simple. You don't have to spend energy to get this information. You open your chart, find the mean of the day, find the the position of the trend MA and then find the position of the dynamic MA. In this case, trade at the retest of a possibility of 90% in get. Okay. Sorry, I think I had a network break and I'm back now. Sorry for that break. Okay, so I'm looking at, I think, let me see it. What happened? Okay. So everything is back now. So like I was saying, I was talking about if you should always anticipate market will pull back to the mean of the day where you find a confluence around the daily pivot and the whatever. And then that kind of structure is what you need to be expecting or anticipating your buy. Irrespective of the ideology or school of thought you find yourself, always do this. And in this case, you can always see that as it is now, the market should possibly is giving us a market a view that there could be a rally, a raid of this zone at the point at this top here. So if I'm buying here, I'm going to expect a rally raid here, and then I'm going to expect a drop. Why? Because TDI is already giving me an extreme positioning, and then this market should come like this and form a divergence at this point, and this should be my level 3 behavior in the market, and then I can expect a drop in this case in gold. So I'm possibly expecting a buy from 1850 zone or 1848 zone, and then a TP around 1868 zone, and then a stop and then a sell again from this zone to the downside. I hope that clarifies a whole lot of things. Okay, so if you take a look at the 4-hour perspective, this is what we had last week. The market traded this high, right? So if the market traded this high, then also we had a structure here. So I'm looking at a possibility that we have this, and then this. Then in that case, we are done with a previous week high rate here, and then we can say we can sell this market back to this zone around 1827 zone level. So let's put price tag to this. I'll buy gold around 1848. I will sell gold around 1868, and then I will TP gold around 1826-27 zone this week. And that is what I have in my trade plan, just what you have here. So if you come to the intraday, you will see that 1848 is around this daily pivot where the trend MA will become a confluence zone on this perspective. And I hope this clarifies a whole lot of things for us here who are possibly getting introduced into how the market maker plan pattern is being operative. Okay, in case you have any question, just raise up your hands and then I will unmute you that you can talk so that we can bring this session to an end. Okay, so now let's take a look at this market before we go into question. I'm expecting you to raise up your hand in case you have any question, then you can be unmuted. So this is the previous day low. Now in this case, the previous day low has been raided. So before the raid, we had this consolidation phase here, and therefore market could drop here, or if the market goes this way, then we'll have a market movement back to the mean of the day. The market will always come back to the mean of the day. The mean of the day must not be violated. If it does, then the bias of the day are switched. So if I'm buying here, if I see a close above this level, I'll buy here, I'll TP here, I'll put my stop loss very tight. But if I see a pin bar rejecting this level, then I'm going to sell with a view of looking at a more downside view, because the daily directional bias is still very much bearish. So if I see a close above this level, I consider the market movement back to this level a rate of low, and then a recovery, a quick recovery. So this is going to become my vector candlestick, which I call sell to buy, and then a swift run, which violate this level, we consider as my shift. Then I can possibly wait for a retest and then buy cheap, put stop loss, and then TP. And then at this point, I will wait for the price action and see. If the market rejects this level, then fine, we look at sell again. But if you close above this level, that means the directional bias for the day has completely switched and changed for that particular asset. So now, like I said, what indicates a directional bias change is the variation of the mean value and the trend MA. If you don't have a directional bias view, it's still very much intact. I hope this clarifies a whole lot of things. Thank you very much for your time and attention and on this, and then we all can go into our daily session. For somebody that talking about level count, I think you can see a visible trade drop in this case. Okay, that's our level. Now, in this case, somebody will ask, what is the anchor? I want to say the anchor in this case was a outside structure giving us a M top, and then this is now our level 1, our level 2, and if this level violate this level, then it will be considered as our push 3 or level 3 in this regards. Okay, and that settles up a whole lot of things. Thank you very much, and God bless you. Do have a wonderful day, and bye-bye. Question, if you have any, I will unmute you. USDS, Marine, USDS. Let me see. USDS. So from the point of view, I will start the USDS from the higher time frame perspective, which is 4 hours. So, but this is what I want to do now. I want to look at it from the angle of simplicity. Looking at the last 1, 2, and 3, the market made this drop, and then we had this. So I will consider this high as a possible supply zone in this market. And then I will say, okay, market has just did this. I just done this back and forth into this level. All things being equal, I want to wait for a possible rejection of this zone. If this market, this candlestick that has 11 minutes, this candlestick on 4 hours has 11 minutes to close. All things being equal, I will therefore wait for the next candle. If I see this candle as an engulfing to hit by the next 4 hours, which is going to be the candle that will close by 2 o'clock. If the candle that close 2 o'clock happens to be an engulfing, in this case, then it means that I'm going to be expecting a further decline in the dollar index. And in this case, if a dollar index goes weakening, then EU, GU, and other pair will possibly go bullish. Now, this is it. Now, how do you look at the TDI in trading to confirm if the market is still in a bearish phase or not? When the market baseline, which is the TDI, is below the static 50, trend on the higher time frame is bearish, and therefore you want to expect a retest of the price line to get to the 68 zone, and then come off for a resistance, and then you sell. Okay. However, you will not sell until you can see a price action validating that order. Otherwise, a close above this level like this, we open a possible retest and maybe something rally back to this. Some people call it QML, but I don't know what I will call it here. Thus, a support and resistance view. So dollar index on a good day should reject the current market price and therefore open a possible downside movement. However, a close above this price, 96.25 on the 4-hour perspective, by the end of the day, we open a further rally to 97.25 zone. And this is what I am seeing on this price chart at the moment. I hope this clarifies a whole lot of things. However, if we see an engulfing around this point here, maybe by 2 o'clock, then it means that the bearish whatever holds, and then we can expect a new low with a view of market targeting this level here. And that should be something that will guide us in our precepts, looking on what is going to happen on the intraday perspective. So let's go to the liquidity engineering that is likely in this market. Now, the previous day high has been violated. So identify that the market had a consolidative phase prior to the violation around this zone market. So a trade back to this level, a retest of 50 EMA, like of 55 EMA, then a possible rally could be seen. However, if this market closed below this level, then it means that we might see a further decline. But I'm still going to be holding a bullish view in this regards, why this market is trading above this trend MA and then this mean value today. So we could see what we call the AR00 anytime soon, AR00 anytime soon around this in this market anytime soon for a market run to the ADRI. So the ADRI is still very much open in this case. And that is my view as far as this pair dollar index is concerned. Okay, thank you very much. So in case you have questions, just let me know. Please, is there any video that explain this from the beginning? I can't relate. Oh, I'm sorry, I will create a room for that. Me too. Okay, I'll create a room for that. Technically, I believe that this meeting is just a follow-up on what we have done in the previous. Yeah, you have the recording after this session, what we have done from the previous session. So, hey, Kelechi, can I, thanks for the video session. Okay, thank you very much, and God bless you. So, in case you want to communicate, you want to ask questions verbally, just raise up your hand, then I will unmute you. Allowed to talk. So, Bala Usman, you can talk now. Good morning. Good morning. Okay, Nokia 6.1, you can talk now, sir. I think that's all I have. So in the absence of no question, let me call it a day at this point and wish you all a successful trading career as the case may be. Thank you and God bless you. User, allowed to talk. User, you can talk now, sir.
Hello, teacher. Good morning. Good morning, teacher.
Good morning, sir.
Yeah, good morning.
Yeah.
This is Anthony speaking. Please, in the course of this presentation, you always use 50 EMA and 55 EMA interchangeably. Are they the same, or is there any difference between the two?
No difference. The same, no difference.
That's just what I want to know.
All right, sir, thank you.
You say them interchangeably. Thank you.
All right, thank you. All right. Bala, you want to say something, please? You have been unmuted. Hello, sir. Hello, sir.